Picture this. You buy a $500,000 home, put 10% down, and lock in a 4% mortgage rate. Sounds pretty reasonable, right? Now, how much interest do you think you'll actually pay the bank over the life of your mortgage? Would you guess around 100,000, maybe 150,000 if you're feeling pessimistic? The real answer, over $250,000 in interest alone. That's money that doesn't build equity, renovate your kitchen, fix your roof, or grow your retirement savings. It simply goes to the lender as the cost of borrowing. Here's the part that isn't always talked about. When people shop for a mortgage, almost every conversation revolves around one number. What's my monthly payment? Very few people ask, how much interest will I pay over the life of this mortgage? In my opinion, that's one of the most important numbers you should know before signing your mortgage documents. The good news is that there is a simple strategy that can shave up to 6 years off your mortgage and save you tens of thousands of dollars in interest without dramatically changing your lifestyle. Sometimes it's not about making bigger financial sacrifices. It's simply about making smarter mortgage decisions. Here's an example. Purchase price $500,000, down payment 10%, that's $50,000. That leaves a mortgage amount of approximately $450,000. Because you're under 20% down payment, the government requires a default insurance premium, about $13,950 in this case. And no, you don't write a check for that. The bank just tacks it on your mortgage, bringing the real total to $463,950. There's 8% PST tax on that insurance premium, roughly approximately $1,116, and that one you do have to pay in cash on closing. Now let's look at that payment. At 4% over a standard 25-year amortization, your monthly payment lands around $2,449. Sounds great, right? You hear $2,449, check it against your budget, and think, I can afford this. But affording the payment and affording the interest are two completely different things. So let's do the math. Your listing sheet conveniently leaves out, over 25 years, that's 300 payments of $2,449, a total of just under $735,000 paid on a mortgage that started at $463,950. The gap between those two numbers, roughly $271,000, is pure bank profit. That's a down payment on a second property. Why is it so high? Because mortgages are front-loaded on purpose. Every month, interest is calculated on whatever you currently owe. In month one, you owe $463,950. At 4% annually, that's about $1,547 in interest for the single month alone, out of $2,449 payment. The bank takes its cut first, and only around $902 actually chips away at your principal. After 5 years of faithfully making payments, you'll have paid roughly $146,900 in cash to the bank. Your mortgage balance only down to about $404,150. So you paid nearly $147,000, but your debt only dropped about $59,800. That missing $87,000 or so is the bank's cut. If you sell in year 5, you've paid maximum interest for minimum equity. People ask me this almost always. Should I stretch to a 30-year amortization to lower my payment? Stretch it out and your payment drops to about $2,215. A $234 a month win. Feels great. Covers a chunk of your car payment, maybe some groceries. But total interest jumps to around $333,000. You saved $234 a month, and the bank just made an extra $62,000. This is exactly why banks love longer amortizations. More time, more interest, more profit for them. So how do we fix this? Just one rule. Every extra dollar you pay above your required payment skips the interest calculation entirely and goes straight at your principal. Back to our $463,952 mortgage. Baseline is $2,449 a month, mortgage-free in 25 years. Roughly $271,000 paid in interest. Now, let's add $500 a month on top for a total payment of $2,949. That extra $500 lowers your balance immediately, which means Next month's interest is calculated on a smaller number, which means more of your regular payment goes towards principal. It snowballs. The result paid off in roughly 18 to 19 years instead of 25. About 6 years gone, and you save somewhere around $75,000 to $80,000 in interest. That's real money, essentially tax-free, just from an extra $500 a month. Can't do $500? I get it. Groceries are brutal right now, gas isn't cheap, and $500 might feel out of reach. So do $100, do $200. Got a tax return? Throw it on the mortgage. Most lenders let you make lump sum prepayments of 10 to 20% of your original balance per year. So a bonus, a refund, a windfall can all go to work here. Split it if you need to. Some toward the mortgage, some toward other debt. Even one extra payment a year, just one knocks time off your amortization. This isn't just about saving money either. It's about protecting yourself. Every 5 years, you renew. If rates have climbed to 6% by then, your payment could jump hard. But if you've been aggressively attacking principal in the meantime, your balance is lower going into that renewal, and a lower balance cushions you against higher interest rates. One critical detail before you go make an extra payment: make sure you select principal only or prepayment, not just a regular payment. Some institutions will treat an extra deposit as an early payment toward your next bill instead of a principal reduction, which just moves your due date and saves you zero interest. If you're not sure how your lender handles it, call and make them walk you through it, because this information is not always voluntary. If you're buying, renewing, or thinking about switching lenders, drop a comment or click the link below to book a call and let's run your actual numbers. This is Russia Ingrata, Mortgage Agent Level 2 with Mortgage Intelligence here in Windsor, Ontario since 1999. Thanks for watching, and I'll see you on the next one.